You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. Today, I'm going to talk to you a little bit about what's bugging me. And what's bugging me is this. I am annoyed with this economy. That doesn't seem like a very professional thing to say, right? Mr. Finance Podcast guy is annoyed. Well, I am annoyed. And the reason I am annoyed is because nothing makes sense. You see, nothing really makes sense. Inflation has been as high as it has been since the 1980s. At first, the Fed didn't think it was real. And then it reacted by increasing interest rates at the fastest rate in American history. Businesses are feeling it. Corporate bankruptcies they're at 2009 levels, believe it or not. It's likely because of illiquid lending markets. The commercial real estate market, as we've all experienced for the most part, especially in our investor group, it's paralyzed. And there's blood spurting through the streets right now. But here's the thing. Last month's job report shows that we added 339,000 jobs, significantly exceeding expectations. As the kids say, WTF, right? What does that mean? It makes no sense at all. Why are we adding so many jobs? And I guess the better question, and the question that we should answer is, well, why is the jobs report important for us at all anyway? Well, that's one of the variables that the Fed is looking at as they decide what to do with rates. Inflation is down to 4%, starting to feel kind of comfortable, right? But a jobs report like that is going to give the Fed sort of they're going to be worried about getting dovish going forward, right? They're looking at this saying, hey, is this economy actually still overheated? Do we need to raise rates a little bit more? So I have no idea what to expect. That's what annoys me. I have no idea what to expect. And if I have no idea what to expect, then other businesses have no idea what to expect. And investors are equally likely to be confused. And the problem is that uncertainty is what markets hate the most. So that's where we are. And again, that's why I am so annoyed. So this week on Wealth Formula Podcast, I'm going to interview an economist who teaches entrepreneurs. Now, he's written a book on how we can start looking at the economy in a practical way, which might be helpful since the impractical academic way doesn't seem to be helping very much. And his perspective is a little different than academics who run the Fed, and he actually doesn't think the Fed necessarily has a good sense of, how to look at the economy, which, frankly, I believe him. So make sure to tune in and hear what he has to say after we come back from these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Per Byland. He's an associate professor of entrepreneurship and Johnny D. Pope Chair in the School of Entrepreneurship in the Spears School of Business at Oklahoma State University. He's the author of How to Think About the Economy, a primer. His website is perbyland.com. Per, welcome to Wealth Formula Podcast.
Hey, thanks for having me.
Really, I think one of the things that we really want to talk with you about is, I think as a professor, one of the questions I have is how does economic literacy explain how society works?
Yeah, let's start with the small questions, right? I think it's really important to understand what economics is and what the economy is. Because to me, society and the economy are like two sides of the coin. You can't really separate the two. So if you understand how the economy works, you understand how to position yourself and how to start a company and all that stuff, of course. But you can also evaluate and assess policy. So economic literacy just gives you insight into how society, in a sense, works and how the economy works. And unfortunately, there's very little of this quality, and surprisingly little, I would say, too. That people tend to have all kinds of ideas of how the economy works, but they tend to be, dead wrong. So economic illiteracy tends to be the standard, unfortunately.
Yeah, I mean, I think that's pretty common, probably globally, right? I mean, so how do you? I mean, when you talk about economic literacy, what are you talking about? Like, are you just talking about a basic understanding of macroeconomics, microeconomics? What do you mean by that?
Well, it's a little bit of both. I mean, it's about understanding how things actually happen. Where does economic growth come from? What does it mean? Business cycles, how do they function? Where does value come from? What the heck is a price anyway? And what is the role of money in the economy? And all of those things that we tend to use every day, and that we have sort of some kind of understanding for practically.
So I know you've talked a little bit about this concept that we are in a period of economic neglect. Tell me a little bit about that.
Well, I think it has to do with the economic illiteracy we just talked about. And I think, in a sense, politics is really the art of offering things that are impossible. The economist Thomas Sowell once said that the first rule of economics, and I'm paraphrasing, but first rule of economics is that things have a cost, and there's always a trade-off. And the first rule of politics is to overlook that rule of economics.
Right.
Right. So in a sense, I think politicians do that when they sell a theory or they sell a policy, and they sell themselves in a campaign. They tend to offer and promise things that are not possible to actually provide. So having some economic literacy means that you're not going to be able to fall for those things, and you're going to be able to really hold politicians more accountable. I mean, that's just one application of understanding the economy much better, that you can tell what is possible and what is not. And the same thing, of course, in your own life.
Do you think that's an American thing, or do you think that's something that that people have a better grasp on economic literacy in Europe or China or anywhere else? I mean, I'm just curious, what's your take on that?
No, I don't think it's an American thing. I think it's rather I think all societies have basically a lacking economic literacy. I think in general, people who are closer to the market and exposed to the market themselves, they would have a better grasp of it. So one thing that I'm surprised when talking to entrepreneurs, for instance, that they tend to understand the economy much better than other people, simply because they deal with it every day, and they know what they can do and what they can't do. They know such things as, well, their customer is boss. They can try to offer whatever they like, but at the end of the day, whether they buy or not is really their decision. The entrepreneur can't really decide for the customer. They can try to persuade the customer to make purchases, but the customer will decide, is this worth it for me or not? Right.
So it's almost more of a practical. It's like more of a practical literacy, because you look at what's going on. Let's just say, academics like Janet Yellen, economically, obviously very literate. But I mean, recently claimed her policies, which, massive money printing, COVID lockdowns, those kinds of things that they did in terms of recovery there, that they were not creating inflation, right? So is there a discord between academic, or is there a difference, I should say, between academic literacy of economic matters and practical literacy of economic?
I think there is. I mean, in a sense, the practical literacy that entrepreneurs have, they typically don't have the words for it. Right? They don't have the theoretical framework. They just have sort of an intuition, but they can't dress it in words. I don't know about Janet Yellen. She's acting as a politician, right? So she's trying to promise things. Whether she understands or not that what she's doing will have certain impact on inflation or the inflation statistic, that's a different matter. I mean, politicians, they tend to not necessarily be truthful, let's put it that way, in their predictions, because they hope that, well, first of all, they want support for what they're doing right now, and they will want to not take responsibility for the outcomes later on.
What do you make of sort of the, I guess, the widespread detachment of economic fundamentals with, I think, what for a period of time seemed to be really thriving markets, like that sort of discrepancy between, what's happening in the economy versus what's happening in the markets?
Yeah, I mean, it sure makes it harder to decipher and sort of uncover what's going on. I don't think that the basic economic understanding that it's always applicable. The issue, though, is that there are so many distortions and manipulations of how it works. And very often it's simply the creation of money by central banks or the banking system, right? That with all this new money that creates all this phenomena that you wouldn't otherwise see. And we tend to think of, when we talk about the markets, we tend to think of the financial markets, but the economy is so much bigger, right? The economy is really the real economy, meaning that it's the physical things, it's the production, it's the businesses, things like that, whereas financial instruments are attempts to work with the financing of it. And the laws of finance are typically different in the sense that you're not actually creating new value, which entrepreneurs do in production. They're creating value for consumers. Whereas in finance, you're moving money back and forth and you're working with statistics in order to make certain bundles or whatever seem less risky, and therefore you can charge more, things like that. So it's a different game in a sense in the finance markets than in the economy overall.
So is that in your view, is that a relatively new thing? I mean, because going back to the Great Depression, and I'm certainly no economic historian, but you start with a big stock market crash, and ultimately a bunch of businesses going out of business and widespread unemployment. It just seemed like there was a much more correlated type of movement between markets and what was happening in the real economy. Do you think that that's true?
I think the link is not as obvious anyway, and I mean that has probably to do with this. Again, it's the creation of new money, because there's so much more money created, and that ends up in the financial markets first and primarily. It leads a different life. And that was not the case before. I mean, you mentioned the Great Depression. Well, we were still in the gold standard, so even money itself was tied to the amount of gold available. Whereas now, money is completely untethered from anything. Basically, they can create them at will and out of thin air, and just create another trillion whenever they feel like it. Right? Just push a few keys on the keyboard, and there's another $1 trillion to spend in the economy. So in a sense, it's different that way. I'm not sure finance itself is different, but the fact that finance gets all this created money makes it different.
So basically the fact that there's more debt, right? There's more debt available.
Yeah, right. I guess you could put it like that, yeah.
Yeah. In terms of your book, when you talk about how to think about the economy, a primer, give us some thoughts on, just some highlights in terms of that. I presume this is written as a primer, so people are like on this show who listen to this are smart people and may want to, start thinking about, well, okay, there's a lot to think about here. There's a lot of terminology. So where does one start?
Yeah, and that was exactly the point with writing this primer, that there was no good place to start. So people often ask me, so if I want to learn about the economy, if I want to not dig very deep, but at least gain some basic knowledge, where should I start? What is a good article to read, or what is a good book to read? And I didn't really find any good ones, or not good enough. So, or if they are good and you can read them, they're usually very expensive because they're published by academic publishing houses. So in order to buy the book, you need to spend like $80 or something like that. And for most people, learning a little bit of economics is not that important. So they wouldn't want to spend that much, and they don't want to invest all that much time either. And like you mentioned, there are plenty of terms and jargon and math and all of this stuff. So the whole point of the primer was to produce an overview of the economy so that you can quickly sort of get a feel for an understanding for how it works in all its parts, and not spend a whole lot of time. So you can read it in an afternoon without problem because it's really short. There's no jargon whatsoever, and it's cheap. I mean, it's $5
Sure.
or $8 from Amazon.
So in terms of just to give like sort of just some general ideas. I mean, what do you recommend in terms of where do people start? I mean, in terms of when you start talking about the primer, how did you decide what to talk about in there?
Well, it was not really difficult because it seemed pretty obvious. Because the problem with economics is that you have to think about. I mean, since we're talking about people acting and people reacting, and the whole economy is really based on how people value different things and how they make choices. I had to start talking about how we need a framework to understand what is going on before we can start measuring things. So it's really not suitable for using the same methods as in physics, for instance, where you can measure the weight and mass and so forth of things. But since we're talking about value and what people value personally, I mean, subjective value is core to it, you really don't have a metric for it. And even money itself is an economic concept that requires some understanding. So you have to start with talking about, okay, so how can we at all decipher and uncover what is going on? Well, you need a framework for it. So I had to start talking about that. And then I could dig into talking about what is actually going on in the economy.
And what is going on in the economy?
Yeah. Well, this is a primer on how to understand the economy, right? So I'm not actually giving there are no investment advice or anything like that. It just gives you a baseline for how you can then apply this line of thinking. And I mean, there is an economic way of thinking about things. And typically it's sort of the reverse of what we tend to think. So when we see something, we see sort of a monopoly, or we see someone who's rich and something like that, we tend to think about it in a certain way, but economics uncovers the process that led to it. And if you have just a basic understanding for those processes, you can also uncover where this comes from. And then you can make a much more educated assessment of whether you think it's right or wrong, and not just see it and have an instantaneous reaction, but instead understand it. And then based on that, you can make up your own mind.
Obviously you're an economist. So tell us kind of, I mean, obviously we're in a very unusual time right now. What's your take on what happened here? I mean, just obviously we had this, they had the COVID, and basically everything shut down. We had massive money printing. We had helicopter money. How did we get to where we are without necessarily figuring out what was going to happen? I mean, how did that happen? Just as an economist, give us your play-by-play from your perspective.
Well, I mean, I think there are plenty of bad moves, really, because very often the reaction in terms of economic policy has been to get rid of the symptoms quickly, rather than think of the long term. And the economy is cumulative, and there are plenty of innovations that build off of innovations and build growth over time. And then as soon as there's a hiccup, and usually the hiccup is created by interventions in the economy, but you want to quickly get rid of the symptom and just move on, right? Which typically means that you enter, or politicians do, and they try to fix the problem or make sure to build, in a sense, build another bubble on top of the bubble that just burst.
Right.
And if that is how you're dealing with things, and you're sort of short-sighted in this sense, you're going to build bigger and bigger bubbles to just swallow the previous bubbles that burst.
Right.
And that's sort of where we are right now. And eventually, you're not going to be able to build another bubble, and then well, then we're going to have a lot of problems. Because there's, I mean, one of the implications of my book and what I talk about there is that there is such a thing as an economic reality. Unfortunately, a lot of people deny this today. So they say that there is no such thing as an economy. It's whatever we make it to be. And they're right in the sense that we make up the economy. The economy is made up of us and what we do, but it doesn't mean that we are not limited or restricted by economic law and certain the nature of the marketplace, for instance. And so we need to understand this in order to manipulate it, if we will, or use it to certain ends. This requires that we have an understanding, or we're going to create problems that we simply could not foresee. And I think that's where we're at now. I mean, the great financial crisis of 2007 and 8. I mean, it was really a response to the bubble that was created before then, the housing bubble, which was created in order to, in a sense, swallow the bubble. It was the dot-com boom before then. So I mean, it's bubble on top of bubbles, and they're just getting bigger and bigger and bigger. And then, of course, now with the pandemic, it was not really an economic bubble that burst, that they created, but it was this. They needed a reaction to it, and of course, they chose to just pause businesses. And I mean, as an entrepreneurship professor, I don't even know what that means, to pause a business. There's no way you can do this because it's a process.
Right.
And that meant that they had to give people a lot of money in order to just be able to pay their bills, and because they couldn't go to work. Right. But that also means you have a lot of people who can demand things and buy things in the marketplace because they get all this money. But who's producing this stuff? No one is producing the stuff because they're all at home. So that, of course, is going to bid up prices like crazy.
Yeah.
So everybody has money and everybody wants to buy stuff, and no one is producing more stuff. So you have less stuff than before and more money to buy it.
Yeah.
Of course, the prices are going to skyrocket, and that's what we see too.
Interesting. Why do you think that was not clear to the Fed? I mean, what's your take on that? Do you think they thought it was transient? What did they miss? I mean, there's a lot of smart people in that room,
Yeah, there are. And I mean, in a sense, this is going to sound weird, but in a sense, it's a lack of economic literacy.
Yeah.
Because macroeconomists in general don't really have this sort of old style economic literacy that I'm talking about. There's no conception of entrepreneurs, and there's no conception of businesses. There's no conception of production or things like that. Instead, they're dealing with aggregate statistics. So they're talking about the unemployment rates, they're talking about the price level and things like that. And they're assuming that there are certain relationships between these aggregates. But any sort of real economist, quote unquote, will say, well, the unemployment rate is really a bunch of people who cannot find a job compared to how many have jobs. But why can't they find jobs? Well, there's something in the economy that means that leads entrepreneurs to not start businesses or not expand their business and therefore not hire people. So there are sort of, in academia, we talk about the micro foundations of these things, right? That there's individual actions that give rise to these phenomena, these economic phenomena, but we can't really understand the phenomena without talking about how they came out of what people were doing. And macroeconomics, typically, they ignore these things.
I'm curious on something that, again, this is an unusual economy, and where I feel like it is, I feel like the problems are being more felt on a top-down basis this time, whereas, with businesses having trouble maybe getting, good financing and certainly in the apartment space, we're seeing that in big multifamily apartment buildings and complexes. Meanwhile, great jobs numbers, right? How does that happen? I am so confused by this, I have to tell you, because it sounds to me like I'm hearing that the number of businesses that are declaring bankruptcy is extremely high right now. I keep hearing, and I know from personal experience as a business person that the lending market's making it very challenging for everybody. Inflation is a problem for businesses. Why are there so many jobs being created in this economy? Because that seems to be part of the problem in terms of inflation.
Yeah, I mean, you're right that nothing really seems to make any sense, right?
Yeah.
But when we're talking about unemployment, we're talking about a lot of people who left the job market. I mean, unemployment is how many are actively seeking jobs and don't have one, compared to the people who have jobs. And a lot of people left the job market because it was simply they couldn't find jobs, and in the pandemic they're like, what the heck, I'll retire or I'll just live off of mom and dad or whatever it might be, right? So people left in that way. That affected the statistics. You're right that many businesses went under, so there were fewer jobs in absolute numbers, but also fewer workers in absolute numbers. And at the same time, you have plenty of new money that you give to people as consumers, and also that you invest in new businesses so they can hire people. But are they actually producing for consumers? Well, they're producing for the new money. So it's not people earning wages in the same sense as before, and then economizing on their purchases. Instead, you have people getting more money than they earned, quote unquote, and spending that in the economy. And then you have venture capitalists investing much of this new money that they got in financial markets into businesses that they wish to scale up. So you have plenty of businesses where the businesses don't really make any money, but they're expanding like crazy anyway, because they think that later on, if they get into a monopoly situation, or if they're like the only one that will deliver groceries or whatever it might be, and all businesses, all the stores use this platform to do it, then they can start to make money off of it. So they're sort of starting and expanding based on debt and not really having sound figures, and then they're hoping to find a business model later on.
Really good. Last month, I believe it was 339,000 jobs, and soaring way past expectations.
Yeah, much of this is simply that the economy is functional again after the pandemic.
Yeah.
I mean, but you're right. I mean, none of these statistics make any sense, and of course, the statistics are. I mean, how truthful are they? That's also an issue always.
Well, and then the problem is that's what the Fed is going to base decisions on, right? I mean,
yeah, of course.
So what's your take on interest rates? Do you think that they need to continue to go up? Do you think that, I guess it depends a little bit on what you think the medication that the economy actually needs is, right? If you want to get us quote unquote soft landing, you want those rates to stabilize and maybe go down a little bit, versus if you want to sort of clean house, you probably let them rise. So what's your take? And I think, just for clarity, I think you kind of come from the Austrian economic school, right? So I'm guessing you're going to say, let those rates rise, right?
Yeah, you're right. And for the simple reason that they have been kept artificially low for so long. And when you keep interest rates too low, or not too low, but lower than they otherwise would have been, it means you get a lot of investments that are not really made because there is value to be created for consumers, but instead because there seem to be profit to be made because the interest rates are lower than they otherwise would have been. So you have sort of overinvestment in some sectors, which means you have relative underinvestment in other sectors. And what drives this is the interest rates rather than expectations of what consumers will buy. So in this sense, I mean, I wouldn't say they may necessarily clear house, but there are plenty of businesses that are producing things that consumers are not really expected to demand. And there are businesses that should be operated and it should be started, but have not been because these other businesses have hired the people and have used the resources. Right? So there's sort of a distortion in the overall economy that is structural. So maybe we would have seen exactly the same number of jobs, who knows, but the jobs would have been in other businesses had the interest rates been allowed to sort of reflect the actual fundamentals in the marketplace.
We've lived in like this period of time where the Fed has been so reactive to the markets, right? That part of me thinks that the reason for those jobs is that the real economy doesn't believe the Fed, it's essentially saying, yeah, they're not going to keep raising rates. Before you know it, we're going to be back booming again, and we don't want to get caught behind when they're bluffing about continuing to tighten things up. What do you think?
Yeah, I think that is right. And I mean, in any business, you can't really base your decisions on the past. You have to base your decisions on the best possible expectations. And that's true when you start a business. You can't know what people will buy from you or if they will. You have to make an expectation and then make an investment based on your best guess. And it's the same thing with the Fed. If your business depends on interest rates doing this or that, being high or low or what have you, then your expectation is going to be what you're going to make your decisions based on the expectation. And this is also then why we have the Fed going out and saying things, not because they're actually going to do it, but because they think that saying it will create these differing expectations so that the behavior will be what they actually want.
Right.
So they might say that, we will increase interest rates, and they know that no one is going to believe them. But if they say that we're going to keep interest rates the way they are, then people might invest even more in certain things.
Yep.
So they better say something that they know is not true, and it's not their intention whatsoever, but they think that the outcome will be a certain behavior.
Yeah.
Which of course is it's really really weird, because you can't really foresee how businesses will react to this if you're trying to sort of second guessing and playing that game instead of setting interest rates and just using the tools, right?
One more question for you, which is this, is that, I know you have no crystal ball. None of us do. But what do you think is going to happen? What do you think is going to happen? I mean, this is kind of another strange period in American economic history. The slope of these rates going up so fast. It's remarkable to me that we have not seen that much destruction yet. What do you foresee happening?
Well, I don't really foresee the Fed raising interest rates, because I don't think that they're able to, because as soon as they try, and I mean they try to reduce the money supply a bit, and then of course the reaction is swift, right? So what I'm looking at really is entrepreneurship and the creation of value for consumers, and what is the economic structure in terms of actual production, actual use of labor, actual use of resources and things like that. Is that actually in line with where entrepreneurs would put them had they not been subject to all these manipulated signals, in a sense?
Right.
And from that perspective, the economy is sort of out of whack. The structure is wrong. It's distorted by all these signals, and that requires a correction. Now, does that mean that we're going to see a depression in the next year or 5 years? Not necessarily. I mean, it's going to be correcting a distorted economic structure will require, it's going to be costly no matter what. But it could be that it's a sort of an extended process with businesses going out of business, or some producers shifting to another industry, but they're not doing it en masse. Instead, they're doing it a little here and a little there, which means we're going to have much less economic growth. So maybe we'll see stagflation. That's a possibility, right? The extended stagflation. I mean, I'm not saying that's going to happen. Who knows? I can't. Like you said, I
so
don't have
stagflation is so high unemployment, right? Without economic growth, right?
Yeah, high inflation, right? Inflation and no economic growth.
No economic growth, right? So so that's kind of what your thought is. So maybe it's not a big, blood in the street, the type of thing that you think of with a big crash, but just sort of a prolonged period of stagnation, like Japan or something.
I hope it's not a crash, but I mean, it's not.
Yeah.
It's not impossible.
Yeah.
And I mean, the way it's looking now, I mean, if you want to put on sort of a pessimist's hat, then it's not looking good at all in terms of the structure of the economy and what is going on. So it could turn into a depression because it seems like the Fed and politicians are definitely focusing on getting rid of symptoms and thereby extending a crisis rather than actually letting the market sort itself and the economy fall back into its right track, sort of. The issue now, though, is that the depression happened under the gold standard, where money was tethered to something, whereas now money is what? It's nothing at all. So the question then is, well, what is the bottom? Is there one? So I mean, the worst case, this could be hell, but typically I think we underestimate the market economy. It's much more resilient than we expect from it. So I'm hopeful that we're not going to see chaos, but there's no way, I'll tell you.
Yeah. Again, the book is How to Think About the Economy, a primer. Is available on Amazon, the usual places, pretty much everywhere you can get a book. or is it just at your website?
No, I mean, Amazon would be probably the easiest place to get it, as usual. You can also download it for free. So the PDF version and the audiobook are both free. And you can download it from mises.org/primer. Mises.org/primer. So it's mises.org/primer.
Fantastic. Per, thanks so much for being on Wealth Formula Podcast.
Thanks for having me.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. And so now you can see why I'm annoyed. You could probably hear me being annoyed. Doesn't make any sense, right? Bottom line is, it is an economy that is schizophrenic, and I'm just waiting for it to declare itself. Which personality are we going to go with here? And that's a tough place to be. So anyway, I guess, the only thing that we can continue to do is, just pay attention and wait for opportunities to come. If you haven't done so and you are an accredited investor, think about joining our accredited investor group at wealthformula.com, because we will react in one way or another when the time is right. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.